On the surface, the US consumer is holding up fairly well, with unemployment close to record lows, wages continuing to grow on average every year, and retail sales pushing new all-time highs. However, when we dig deeper into the data, there are in fact some major alarm bells ringing, suggesting that we're about to see some major weakness across consumer spending. We're in a situation where many US consumers are in an extremely vulnerable position right now, and we are now one step away from consumer spending completely collapsing, which could be a trigger to bring the entire US economy down with it. US job openings have fallen yet again to 8.79 million, now at the lowest that they have been in more than 2 years. The speed of this decline in job openings is getting worse and is now at minus 18.2% compared to a year ago. And this rate of decline is exceeding all other time periods in history, with the exception of the global financial crisis and the blip that we saw in 2020 because of the pandemic, which is a very worrying sign to see. The large volume of corporate debt that is maturing in the coming years, coupled with sky-high interest rates, is likely to be a reason as to why many firms are slowing down with their hiring. And according to Goldman Sachs estimates, there is about $1.8 trillion in corporate debt maturing over the next 2 years, which does vastly exceed the annual levels of corporate debt maturity that we have seen in recent years. And this won't be slowing down anytime soon either, as this debt maturity doesn't peak until 2028. And when you combine vastly increased corporate debt in 2024 and 2025 relative to 2023, combined with interest rates that are likely to remain elevated for the foreseeable future, many firms are going to be hit with higher debt servicing costs. Now this will eat into company revenue, and strategists do estimate that for every extra dollar spent on servicing debt, capital expenditure will be cut back by 10 cents, while spending on labour will be cut back by 20 cents. And this reduction in spending could hit the job market by 5,000 payrolls a month in 2024 and 10,000 payrolls a month in 2025. And with corporate debt defaults in 2023 surpassing the total number of defaults in 2022, experts have warned that $1 trillion in corporate debt could be at risk for default if the US faces a full-blown recession. The unemployment rate today remains at very low levels historically at just 3.7%, but we do know that based on historic data, this is about to change. And this is because the unemployment rate is a lagging variable that follows the federal funds base interest rate with a strong correlation. As the federal funds rate rises, unemployment tends to start rising to follow it several years later, and we can see that this relationship has remained consistent throughout decades of historic economic data. It's been close to 2 years now since interest rate hikes began, as we can see that the first major rate hike took place in April of 2022, and since then we have witnessed rates be hiked at a record-breaking speed. And this historic relationship therefore tells us that it is likely that we start to see the unemployment rate surge at some point in the next couple of years, and this could potentially begin in 2024. The prospect of millions of employees getting laid off in the coming years really paints a grim picture of how severe the next recession could be, especially when we consider a number of other things lurking in the background that makes the US consumer a lot weaker than many people think today. Credit card debt is a prime example of how vulnerable many consumers are right now, as it continues to surge at the fastest pace that we have seen in history, now exceeding $1 trillion. Historically, the interest rate on credit cards has hovered in the 13 to 16% range. However, this has surged since the Fed started raising rates to now being at around 23%, significantly higher than what consumers are used to. And when you combine record high volumes of credit card debt with record high interest rates on this debt, this is a disaster waiting to happen. In fact, we are already starting to see a surge in credit card delinquencies taking place, now at slightly under 3% today compared to being at just 1.55% in 2021. This is now the highest credit card delinquency rate that we have seen since 2012 and significantly exceeds pre-pandemic levels. And although we still remain below the levels that we saw in the 2000s in the run-up to the global financial crisis, the rate at which we are seeing delinquencies increase is actually higher than this period. And as you can see, delinquencies are increasing at the fastest rate in history, growing by around 45% year on year, a faster speed of increase than during the 2008 to 2010 time period. And when you consider the fact that all of this is taking place during a time where the job market is still relatively healthy in the grand scheme of things, it is concerning to think about how much worse things could get. As we saw earlier, the unemployment rate is extremely low relative to the past, and there are very few Americans that are without a job who do need one. When this unemployment rate, a lagging variable, inevitably rises to follow interest rates like it always has done in history, then we could have a big problem on our hands, and millions of Americans could be laid off and without a job, unable to pay back their credit card debt. And it's not like consumers have any excess savings to fall back on either if things are about to get worse, with the personal savings rate near all-time lows. People are saving just 4.1% of their income on average, which is near the lows seen in 2022 and far lower than what we have seen pre-pandemic of around 7%. If you exclude 2022, the savings rate is actually the lowest it has been since 2008, yet another similarity between today and the time period of the global financial crisis. And although this combination of rising credit card debt and dwindling savings may be caused by some people continuing to spend like they did when times were better before inflation got so out of control, the data doesn't suggest that this is the case for the majority. And retail sales have actually been slowing down ever since the Fed started raising rates, suggesting that many people are being pushed to their absolute limit just to keep surviving, going into debt in credit cards to do so. And the ridiculous housing costs that homeowners and renters alike are facing in today's economy is also likely to be a major driving force behind this too. Wages are not increasing anywhere near fast enough to keep up with rising house prices and very high mortgage rates right now, meaning that new homeowners are spending a whopping 40.5% of their income on average every month just to afford a medium-priced home. Now, this is about double the portion of income needed during the majority of the 2010s and exceeds the peak that we saw during the global financial crisis of 34%. You would in fact need to go back all the way to the 1980s to find a period of time where it was this unaffordable to buy a medium-priced home. Mortgage rates have come down slightly since this data was taken, meaning that these housing costs may be relieved a little bit today, however they will still be very high and clearly having a major toll on many people's finances. And renting has also risen a lot in recent years, despite not being at the same pace as home ownership, with the average rent now being over 22% more expensive compared to pre-pandemic. It's clear that the US consumer is extremely vulnerable right now. The job market is showing signs of weakness already, with the likelihood that we are going to see layoffs begin to ramp up quite significantly in the coming year or so, which means that things could get ugly. We know that we are almost certainly either already in a recession right now, or one is just around the corner, and this is because almost every economic indicator that has stood the test of time is signalling this right now. The Conference Board's Leading Economic Indicators Index is screaming a recession, as the year-over-year change in this index has been below the 5% threshold that has always indicated a recession is coming. We're currently sitting at minus 7.6% on this index, and as you can see, being below this minus 5% threshold coincided with the 2020 pandemic, the global financial crisis, the dot-com bubble, as well as the 1990s and the 1980s recessions as well. This Leading Economic Indicators Index is probably my favourite metric to use to forecast recessions, because not only has it never failed in the past, but it does also use an aggregation of a broad range of indicators rather than relying on just one. This does include average work week, jobless claims, building permits, stock prices, credit indexes, the interest rate spread, as well as several order types. And of course everyone knows about the inverted bond yield as well, also being a recession indicator, and as you can see on the bond yield it is currently inverted, a landmark that was reached just before other historic big recessions as well. This does show that the market is moving money away from short-term bonds and into long-term ones instead, meaning that the market as a whole is more pessimistic about the economy in the short term. The banking sector is another area of the economy under a lot of stress right now and could be close to complete carnage unfolding, having detrimental impacts on the wider economy. I cover this topic in more detail in my previous video, which you can check out by clicking on screen right now. Aside from that, please leave a like on the video and subscribe if you enjoyed it, that does help out the channel a lot, and thanks a lot for watching.